Hi there. Today we're revealing how small gains across the year can combine under the 2026 CGT Aggregation Rule and push you over your allowance. If you invest or sell assets, watch this.
Hello and welcome. Today we're going to be talking about a major tax trap that's catching more and more people out in the UK. It's called the Capital Gains Tax Aggregation Rule, and it's the sneaky reason why a bunch of small profits can suddenly morph into one very unexpected tax bill. Now, this entire guide has been put together by the tax experts over at Pro Tax Accountant, so let's get straight to it.
So, let me ask you something. Have you ever sold a little bit of crypto? Or maybe you offloaded some old shares you'd forgotten you even had? Or perhaps sold an antique you inherited and made a little bit of profit? You probably just thought, nah, it's nothing, right? Assumed it was far too small to ever bother the tax man. Well, you might want to think again. You see, for the current 2025 to 2026 tax year, the tax-free allowance for these kinds of gains is just £3,000. It's a tiny amount, and this really low threshold is catching thousands of ordinary people out, turning what used to be a tax-free bit of cash into a real reporting headache. But don't you worry, the team at Pro Tax Accountant put this together to help you navigate it all.
To really see what's going on, just look at how dramatic this change has been. It's quite something. Just a few years back, in the 2022-23 tax year, you could make gains of up to £12,300 completely tax-free. Now, it has been absolutely slashed to just £3,000. That is a massive, massive drop, and it really does change the game for pretty much anyone selling any kind of asset.
Okay, to make this all feel a bit more real, let's talk about Sarah. She's a freelance graphic designer based up in Manchester. And, like a lot of us, she has a few different things on the go. She's dabbled in crypto, sold a few bits and pieces she doesn't need anymore. She's definitely not a professional trader, not by any means. She's just trying to make her money work a little bit harder for her.
So, over the tax year, Sarah makes a few what HMRC calls disposals, which is just their fancy term for selling, gifting, or swapping an asset. She sells some of her crypto and makes a £1,200 profit. Then she finds some old shares and sells those for a £950 gain. And finally, she sells an antique clock she inherited, making another £900. Each one on its own feels like a pretty small, insignificant win.
And if you look at them one by one, not a single one of these gains even gets close to that £3,000 tax-free allowance. So, Sarah's thinking she's totally in the clear. She hasn't broken the limit on any single sale. But, and this is the crucial bit, HMRC has a very, very different way of looking at this. They don't see these sales in isolation. Because when you add them all up, Sarah's total gain for the year is £3,050. Now, you might be thinking, well, it's only £50 over, so what? But to HMRC, that £50 is like a tripwire. By crossing that $3,000 line, even by a tiny bit, she has now triggered a capital gains tax liability and, importantly, a legal requirement to report all of it to them. And this just perfectly shows the power of the aggregation rule.
So what is this rule? Well, it's a cornerstone of UK tax law. And at its heart, it's actually pretty simple. It just says you have to pool together or aggregate all your gains and all your losses from every single disposal you make within one tax year. HMRC is interested in the total picture, the final number, not all the little individual transactions that got you there.
And HMRC follows a very specific order for their calculations. First, they add up all your gains and subtract all your losses from this tax year. Step 2, if you still have a net gain, they then apply that £3,000 annual allowance. And only then, as a final step, if there's still a taxable gain left over, can you use any losses you might have carried forward from previous years. The order here is absolutely critical.
And this is where things get a bit clever. Losses from the current year have to be used first, and this can actually be pretty inefficient. For instance, say you have a £5,000 gain and a £4,000 loss in the same year. Your net gain is £1,000. That's well under the allowance, which is great, but you've essentially wasted that big loss on a gain that was already going to be tax-free. On the other hand, losses you bring forward from previous years are used after the allowance, which is so much smarter, because they only go towards reducing gains you would actually have to pay tax on.
And you'll want to hear this part. This difference in how losses are treated is a detail that catches a lot of people out. I know it sounds like a minor point, but understanding the right sequence and timing when you sell things can genuinely make a huge difference to what you end up paying. It's a massive area for smart, strategic planning.
Okay, so we've got it. All our gains and losses in one year get bundled together. But the aggregation rule actually goes a lot deeper than that. For instance, what happens with things you don't even sell, but you give away?
Or what if you've got a valuable collection and you decide to sell it off one little bit at a time? Well, HMRC has rules for that too.
First off, we need to get our heads around this idea of connected persons. Now, this isn't some vague term. HMRC has a really strict definition. It includes your spouse, your brothers and sisters, your parents and children, and even their spouses. It also covers any company that you control. And when you transfer an asset to one of these people, special and usually much tougher rules kick in.
Let's make this simple. Imagine in year 1 you give a valuable painting to your daughter. A couple of years later, you give her a sculpture that kind of goes with it. Well, under the series of linked transactions rule, HMRC can actually look back over a 6-year period. If they decide that these two items are worth more as a set than they are on their own, they will tax you based on that higher combined value. It's basically there to stop people from artificially splitting up valuable assets just to dodge tax.
Now here's a proper pro tip from the team at Pro Tax Accountant. If you happen to sell an asset to a connected person and you make a loss, that loss becomes what's known as clogged. This is a crucial term. It means you can't just use that loss to offset your other gains from, say, selling crypto or shares. No, it can only be used to offset a future gain you make from selling another asset to that exact same person. It's a really significant restriction that a lot of people miss.
And this same idea applies to collections under something called the sets doctrine. So let's say you've got a beautiful set of 12 antique dining chairs. Well, HMRC views that as one single asset. Why? Well, because they're worth so much more together than they would be if sold separately. You can't just sell each chair one by one to try and sneak under the tax limit. The gain is worked out on the total value of the entire set as if it were one single disposal.
Right, let's talk about another number that is incredibly important for tax. And this one has nothing to do with profit. It's this one, £50,000. This figure is responsible for one of the biggest admin traps in the entire capital gains tax system.
So, here's a little fact that honestly surprises almost everyone. If the total amount of money you get from selling assets in 1 year, so the gross proceeds, goes over £50,000, you have a legal duty to report all of it on a tax return. And get this applies even if your total profit was zero or if you actually made a loss. It's a rule based on turnover, not on gain, and it's designed to give HMRC a better view of high-value transactions.
So, if you do end up with a taxable gain, what rate of tax are you going to pay? Well, for the 2025-26 tax year, basic rate taxpayers pay 18% and high rate taxpayers pay 24%. But I really want you to look at that last line on the slide. The rate for business asset disposal relief, which is for entrepreneurs selling their business, is currently 14%. But look what's happening from April 2026, it's jumping up to 18%. That's a really significant increase that business owners need to be thinking about right now.
Okay, so with the allowance being so low and some of the rates about to go up, what can you actually do about it? Well, thankfully, there are still quite a few smart, perfectly legal strategies. You can time your sales to spread gains across different tax years. You could transfer assets to your spouse or civil partner, that's tax-free, which lets you use their allowance too. For investments, there's a bed and ISA strategy which lets you sell and rebuy assets inside a tax-free ISA. And, like we said, managing the order of your losses is key. And finally, increasing your pension contributions can actually lower your overall income, potentially dropping you into a lower capital gains tax band.
Now, before we finish, it is really important that I say this. This information is for general guidance, and it's accurate as of February 2026. But tax rules are complicated, and they can, and often do, change. You should never rely solely on this information when you're making big financial decisions.
For advice that's actually tailored to your personal situation, you really should speak to a professional. The team of experts at Pro Tax Accountant who put this all together are available to help. You can reach them on WhatsApp or give them a call on 07-985-689912 or just drop them an email at info@protaxaccountant.co.uk. And of course, for more updates just like this one, please do subscribe to their YouTube channel.
So, let's just end where we started, with a question for you to think about. With that tax-free allowance now being so low, are you absolutely certain that all your small, seemingly harmless gains aren't silently adding up to a much bigger tax bill than you think? Thanks for watching.